Hello, welcome everyone. This is Stanley from Value Invest Asia again. Welcome to our Facebook Live April edition, Ask Us Anything. And today we have two very special guests, Jing and Chin from the Motley Fool Singapore. So they are actually my ex-colleague in Singapore, and we used to be some of the first few employees in Motley Fool Singapore where we created the business together. And we always spend a lot of time chatting stocks and always disagreeing with each other actually. And but at the beginning, but I think after a while we kind of see each other's point of view. So today is a great time to chat with them to find multi-bagger stock in the market. And if you have any question, just feel free to ask down below and we'll try to pick it up. We also have many questions that are sent in to us. Just thank you to all of you. We'll try to go through them as fast as we can. Without further ado, I would like to welcome Jing and Chin. Hello, guys.
Hello.
Yeah.
Thanks for having us.
Yes. Yeah. Before we begin, maybe not I would say most people will know you in Singapore, but maybe our Malaysian audience might not be familiar with you guys. You want to introduce yourself and maybe how long have you been investing and how you get started in investing? Maybe Jing.
Yeah, sure. So maybe just a brief introduction about the Motley Fool as well. So we are an online investment advisory company. Started in the US in 1994. Then in 2013, we came to Singapore, and the Singapore office is the very first Asian office that the Motley Fool has around the world. So I started investing, or rather I started learning about investing back when I was like 18 or 19, so it's more than 10 plus years ago. How I got started was that I was learning economics in junior college, and I thought that what was being taught in school was weird and didn't feel right. So I wanted to look for people who actually really understood money. And then I went on the internet, and then I found people like Warren Buffett and some of his mentors. So I bought their books, and the first book I bought was Philip Fisher's Common Stocks and Uncommon Profits. Mm-hmm. So that kind of like formed the intellectual I would say framework for how I think about the stock market and all, because I thought that the book made a lot of sense. And then I actually started investing real money back in 2010, October 2010. So it's been nearly 8 years now. Yep.
Nice. And maybe a short introduction about yourself, Chin.
Hi. So my introduction is not as exciting as Jing's, but so I started investing probably in 2002 or so. So I started with index funds. I was what you call a boglehead, great supporter of John Bogle, low-cost index funds. And then somewhere around 2005, I decided I was a little bored at work, so I decided to spend a bit more time to learn about stocks. And around the same time, I actually picked up a subscription for the Motley Fool in the US, so I've been a member for a good 12 years now. So at the start, I tried many different ideas. The Motley Fool subscription had a lot of different, it's like a good buffet, right? There's so many nice goodies you can choose from, and I just wanted to try everything.
Yep.
And but over time, as the Great Recession came in right, I think 2008 or 2009. It started in 2007 actually. Stocks fell by about 60%, right, on average. Mm-hmm. The index. So it's sort of like you have all these companies which are doing quite well prior to the Great Recession, and it's maybe easier to do well when the economy is doing well. But when the Great Recession came along, it was just a great clarifier that a lot of companies which weren't as strong were really hit by the recession itself, and what was left was this set of companies,
right?
Which I in the end I decided to focus on because these are the companies at a time where where people are saying that this is one of the worst recessions of their generation. These companies are posting growth, and I'm not talking about 5% growth. I'm talking about 15% growth, 20% growth, some even 30% growth.
Yeah.
And I just thought, hey, you know what? I want to focus on this set of companies.
Right, amazing. That's how you become I would say maybe the term most people use will be growth investor. But we also specifically create this topic today, how to find multi-baggers in the market, because I cannot find any other one that is more qualified than the two of you to answer this question? Because from our experience, you talk to I talked to you guys for so many years. Chin has a multi-bagger of more than 80 times his investment, and Jing as well, close to 20 times his investment. We'll share with you the stock that make them such a great multi-bagger investor. But along the way, I saw some guys coming online, Krishna, Hairani, and Sean, welcome. And if you have more questions, feel free to comment down below and share this Facebook Live with your friends. We also we will actually give you a good lucky draw today. We'll pick 2 lucky winners at the end of the presentation of this Facebook Live. If you have a good comment or been sharing our event, I'll send you some of our books. And if you already have our books, I'll maybe send you some of my favorite investing books as well.
Can I take part?
And not for the two of you. Okay. Going back to multi-baggers, right? Maybe we can start with some of the questions that they have sent in. I think people like Arthur, Lee, and Grace asked very good questions on, can you share, when you're looking for multi-baggers, what are some of the characteristics of multi-baggers? What are you actually looking for? Maybe Chin.
Okay, so you left us with some really big shoes to fill in. So, but we'll try. But basically, I think it's important to first understand that looking for companies which have the potential to actually increase by multiples over time is not just about criteria A, B, and C, and if they meet all 3 and therefore it's going to be a multi-bagger. It doesn't quite work that way. Mm-hmm. So I think the best we can do is really to sort of fish in the pond where such opportunities are likely to appear. And I think one of the characteristics for this sort of fishing pond, which I'll look for, is what our co-founder David Gardner says, look for the top dog or first mover in an important emerging industry. And there's a few things to look for in this pretty loaded statement, which is it has to be something of consequence. The industry might be changing the world for the better. And we're looking for the top dog, which not necessarily means the biggest company in there, but the company which is right up ahead, either changing the industry in a profound way for the better, or actually really defining a new way to actually do things. So being the top dog means you're right up front. You're not trying to catch up with someone else. You are, in fact, the one leading the charge to this change. And I think however way you look at, you might be investing in a Yahoo before Google came along. But even looking at the world of search through Yahoo's eyes, I think you'll learn a lot about the industry, especially if it's through the eyes of the top dog.
Right. Okay. So number 1 is looking for top dog in an emerging industry. So maybe a second characteristic, Jing, maybe you want to share with us. What do you look for when you're looking for multi-bagger stocks?
So I think another important quality that I try to investigate in a company is the strength of the management team. So it's also actually one of the other characteristics that David Gardner looks for in some of his best investments. So what I want to find is a management team that is that I think is innovative, that is trying out new things, and that isn't kind of afraid to upend either its existing business or upend its industry. I think a great example, one of the best that I have seen is really Netflix. Back in 2011, Netflix was still predominantly a company that was sending out DVD by mails, and it was getting subscriptions for its service through the internet. But the management team actually saw that the future was actually on online streaming. And back then, streaming wasn't even actually a very widely used word. But management saw that this trend was happening, and then what they did was they wanted to focus all their energies into online streaming, which was a pretty bold move because the entire cash cow of the business was actually the DVD by mail service. Whereas now they are saying that, hey, we are going to let the DVD by mail business go, and then we are going to focus entirely onto streaming. And it has been a massive success in what Netflix has done. So one trait that I really look out for is how far ahead can management, how visionary is the management team? Are they able to anticipate changes, or are they even the ones driving changes?
Right. Okay.
So back in last year during an investment conference that we held, one of our members actually asked us this question. She was asking us, do we think if ComfortDelGro is able to handle all the disruptive changes that are happening in the transport industry?
Mm-hmm.
And my response to her was, it's actually kind of tough to figure out if a company is able to handle disruptive forces. It's more interesting for me, at least, to think about, and more useful to think about the companies that are actually out there driving the change. So Netflix is another good example, because it's out there pushing the changes in the entertainment industry and forcing everyone else to kind of react to what it is doing.
Right.
So, and this also plays back into the top dog and first mover advantage theme that Chin was talking about earlier.
Yeah, so definitely. So number one is a top dog in the emerging industry, and also visionary management that's kind of not be afraid to disrupt their own business, right? And
Yep.
grow in the future. Right, I actually wanted to ask you, give some examples, but you guys are kind enough to talk about Netflix. Do you have another example, maybe one that you recently have bought that is considered in your opinion, is a multi-bagger? Maybe share a little bit about why you bought that stock, and what's your rationale for it?
Sure. Chin, I go first, if that's okay.
Yeah.
Okay, this company is not a company that I had bought shares in that recently, but I think I probably bought shares sometime in early 2017 or so, and that will be the online retail company called Mercado Libre. It operates mainly in the Latin American market. So, top dog and first mover in an important industry, right? So Mercado Libre is actually the largest online, the largest e-commerce company in many of the Latin American markets that it operates in. And then when it comes to visionary management, if you track back at the history of what Mercado Libre has done, what they have essentially tried to do is to remove the friction involved with e-commerce. So it started out with an e-commerce platform. Mm-hmm. Then it moved on to provide payment solutions. So in Latin America, so like in Singapore's case, right, and in Malaysia as well, credit cards are used widely, and it's a common and normal thing for people to have credit cards to be able to pay for goods and services online. But in Latin America, it's not the case at all. So it's actually kind of difficult for people to actually make payments when shopping online. So what Mercado Libre did was to set up a payment solutions to help lessen this problem. And then the company also started a shipping solution. So if you buy goods online, you actually need people to ship your delivery, right? Mm-hmm. So the company actually set up a shipping solution to help expedite the whole shipping process for the buyers and sellers on this platform. So I look at the kind of things that Mercado Libre is doing, and it kind of gives me the sense that this is a management team that is talented, that is able to execute on its ideas, and is able to see where the world was going. Because back in the company was founded in 1999 or 2000, which was right at the cusp of the growth of the whole internet economy, right? So that was like a really a kind of a signal to me that, hey, wow, this guys really sort of they knew what was coming, and they acted upon it.
Right, interesting. Mercado Libre, I think, is listed in the US under MELI. Is that right?
MELI, yeah, that's right.
Okay. Before that, wow, I think more and more people are joining us. Hi, Daniel, Casey, Mahendra, Sean, welcome everyone. Chin, maybe up to you. You have any interesting stock that you recently buy that is considered a multi-bagger, you feel?
Ooh, that's really pressuring. But I think one of the companies which I bought recently was a company called Viva Systems. So VEVA. What it actually provides is sort of a management system for pharmaceutical companies or life science industry companies. Mm-hmm. And it's a software as a service kind of provider. So you actually subscribe to the service, and it provides software to help you manage your clinical trials, your marketing. So actually a whole range of whatever activities you need to do in the pharmaceutical industries. A product like this actually is not, say, special, because I think one of the first people who are able to popularize the idea of software as a service is actually a company called Salesforce.
Yeah.
But what's different about Viva Systems is I think that they try to provide the service which is specific for the life science industry. Because if you provide a product which is sort of generic, the idea that is the penetration within individual industry is not going to be significant, so it might top up at around 10 to 15%.
Right.
But if you have a vertical solution for the entire industry, specific for the industry itself, and I think for the life science industry is particularly useful just because of the very heavy regulation which goes into it, and the importance of the data, because you're talking about data which you're going to use potentially in the future to apply for a patent, which could be worth billions of dollars.
Yep.
So it's handling really important data. It's the first mover within that space, and they're locking in a lot of people within that space. So I think in that sense, you're the first mover in a space, and people are handing over and keeping your important data on your service. And as a recurring revenue, I think it might have the potential. I would never say it's definitely going to be a multi-bagger, but it has characteristics which I like.
Right, interesting. Okay, well, this is a stock that I have not studied a lot on. But I think Sean has a question for you guys. So if you're looking at all these top dog in emerging industry, how do you find information and of this industry and product and services? Where is the place that you actually dig out information about the industry and you feel that the industry is actually growing? Where do you source for this information?
I'll go first.
Yep.
Yeah, sure.
So I think one of our members did ask us this question before. He wanted to learn about the tech industry, for example. And tech is actually quite broad now. Nowadays, it's more and more difficult to define what tech is.
Yeah.
But my answer is, look at the top companies within that space. So your Facebooks, your Amazons, your Apples, your Googles, or as they call themselves now, Alphabet, and really follow those companies. And if you really see that, if everyone's going into AI, for example, or everyone's trying to create their own self-driving car, it's not a sure thing. But if 4 different top dogs are looking to enter a specific or move in a certain way, I think there's a pretty good chance the industry will probably move in that direction. And that really, I think, gives you a view which, if it's in a university paper, then probably it already happened, right? Yep. So if you want to look for things which are happening as we speak, I think the best bet you have is really look at the top dogs in that industry and try to view the industry through their eyes.
Right, interesting. Okay, for Jing, I think for your Mercado Libre investment, I think Krishna is asking you. It is good in right now, but he's asking, is Amazon moving into Latin America, and if so, is that a big threat to Mercado Libre? How do you see that?
Yeah, so Amazon, as far as I know, is actually making bigger investments into Latin America. But right now, Mercado Libre is the largest, and it has been operating in the Latin American markets since its founding, which I mentioned earlier was in 1999 or 2000 or so. So yeah, Amazon may be a threat, but we also have to realize that not everything that Amazon does succeeds. I mean, I love Amazon as a company. It's also one of my successful investments, and I think Jeff Bezos is an amazing entrepreneur. But
Trump don't agree with you though.
I shall not comment on that. Yeah. Where was I? Oh yeah, so Amazon has had a long history of trying out things that have not worked out. So it may or may not succeed in Latin America, but I think the most important thing is to actually look at the potential size of the market. In Latin America, the penetration rate of online retail versus the total retail market is, I believe, somewhere in the region of 3 to 5%. So there's still in my opinion at least, there's still a huge room for a company like Mercado Libre to run. Yeah.
Right. Interesting. Yeah. And even if they fail, Amazon might just buy them.
Yeah. I mean, yeah, that is a possibility.
Yeah. Okay. That's very interesting. Okay. I think Sean asked a very a good question, which I have struggled for many years as well. So I think he feel that when you find multi-baggers, right, how can you convince yourself to stay invested in the company for the long term, because when you see your own shares for you, went up 80 times, Chin, how is that how do you control that emotionally when it drop back, say, another 10%, you'll be losing like, 7 or 8 baggers within it. So how do you control that?
I think I faced this sort of conundrum back in 2011 or so. I think by then Netflix was maybe a 10 bagger or so. So I just sort of convinced myself there's 3 ways that this could go, or call it 2 ways. One, it continues to go up, which in that case, I don't think there's anything to worry about, right? And it's also important to think that really good companies often surprise on the upside. So a lot of times we are conditioned to think of what could happen on the downside. But I think for me, at least, I think it's also reasonable or more balanced to actually think about upside as well. What could actually happen? Speaking of Amazon, for example, the AWS business, I think they only revealed the details of it, I want to say 2015,
right,
or recently, not too long ago. And until then, you had no idea how big this business is and how fast it's actually growing. So out of blue, things which are not visible in the past become visible. And that's an additional value to the company, right? And on the other hand, what if the stock goes down, right? And I just convinced myself that if I hold a company for 5 years, whether the outcome is good or bad, I feel that the learning which I get from following the company throughout this period of time, and hopefully I hold it for 20 years. Netflix itself I've held for 11 years so far. So I feel that the lessons you learned from actually holding a stock for 10 years or 5 years to begin with will actually be far more valuable than whatever lesson which you can learn out there.
Right. I
think multi-baggers is a bit about pattern recognition, understanding what could go right and what could go wrong. It's not a perfect art, but then I think you can sort of tilt the odds in your favor as you hold stocks more and more long term. And I, for one, I'm willing to hold a company too long and have it go down, because the maximum you can lose is 100%. But if you hold on to a multi-bagger, in my case, which I got pretty lucky on Netflix, it can go up by 80 times.
Right.
Which dwarfs whatever losses you make.
Yeah, interesting. Okay, I think your main concept here is to have a kind of like a lock-in period lah. Well, once you decided to buy, lock it in for 5 to 10 years, and don't look at it, regardless of how the price movement goes, and then just review your investment after the 5 and 10 year period. Is that right to say?
You can do that also. That's a pretty good idea.
Okay.
I will go back to or maybe a good idea is what Tom Gardner, our other co-founder, actually said before. If you want better results, think about doubling your holding period.
Yep.
And I think the main thing here is investing is a marathon. You're not investing to make money immediately, but you're also constantly learning. I may have decided that this is the approach which I want to take, but it doesn't mean that I'm not interested in other stocks or other ideas. I'm still learning and testing different styles and trying to make myself better as an investor. And I just feel that by holding stocks for long term, understanding the sort of different seasons that a company actually goes through, that the kind of problems which prove to be fatal, or most of the time the kind of problems which kind of fade away after a while, you do learn a lot. And I think for the case of Amazon, for example, just to bring in an example, sales taxes, for example, was brought up in 2011, and it actually didn't have any impact on them. But back then, it sounded like they're going to lose their entire competitive advantage, which turned out to be not true. So I would really encourage everyone to really act based on real business happenings rather than to speculate on what could or could not happen.
Yeah, definitely. All right. I think we're almost halfway through our interview. Just another reminder: we're having a lucky draw today. You guys, if you are sharing the Facebook Live and giving good comments. I'll pick 2 lucky winners and send some of our books over to your way, right? Remember to ask your question away. And Sir Jing, I'll put you in the spot, right? We talk about good successful multi-baggers that you have made. Maybe can you share a little bit of some of the not so successful ones, some of your failures, right? When you first invested in it, you feel it's a multi-bagger, but then what happened, what went wrong?
Yeah, sure. Maybe I'll share 2 examples, one US company and one Singapore company. The US one will be actually GoPro. So GoPro actually had a lot of the traits that I was looking for. I thought that the action camera market, which GoPro sort of single-handedly started, was a kind of an important thing. People are vain. People want to showcase all their adventures to the world, and GoPro was enabling that, and they were building sort of back then best-in-class products to fulfill that need.
Right.
And I watched a lot of interviews and read a lot of interviews that GoPro's founder and leader, his name is Nick Woodman. Yeah, Nick Woodman. So I tried my best to learn more about Nick Woodman, and I was very impressed with the kind of vision that he saw for GoPro. But the investment didn't work out in the end. I mean, I'm down like I think 80% or so on it, and it's now such a small position that I don't bother much about the company anymore. So I think one of the where the investment went wrong was that GoPro's products I think they were built a little too good in the sense that there's no kind of there's no recurring element to it. Because what I realized with a lot of really good businesses is that there's a certain recurring element to their businesses, right? Like if you look at say Starbucks or Raffles Medical Group, which are both multi-baggers over the past decade or so. They are companies that provide services that people have to go to often. Like in the case of buying a coffee, you go nearly every morning. But in the case of seeing a doctor, you hopefully don't have to go that often. But when you're sick, you do have to see a doctor and all that, and then you go for your annual health checkups and whatnot. Right. So yeah, there's a certain recurring element to the kind of revenue streams that really good companies have. But whereas in the case of GoPro, it's the kind of product where people buy once and then like they may not purchase for the next 5 years or something, because the cameras are just so hardy, right? And then the company also had this promise that they wanted to become a content company, so they wanted to sort of monetize all the all the content that was shot on the GoPro cameras, but that didn't work out. So I think that was more of an execution issue. So yeah, kind of a few things that conspired to break the investment thesis for GoPro in my case. Okay. And then for the Singapore company, it's actually Sarin Technologies. So it's a company that makes equipment that diamond manufacturers use, right, all the way from the planning of rough diamonds to studying a polished diamond. And this is a company that I've lost, I think, 50 or 60% on. And the reason is because the diamond industry is actually kind of inherently cyclical, because diamond is not exactly a commodity, but in the rough sense of the word, the prices of diamond are inherently unpredictable. So it's kind of like the way that commodity prices move, which is a way that is unpredictable. Yeah. And so what I thought was that Sarin Technologies, due to the nature of its products and services, it holds a 70% market share actually in the kind of market that it operates in. So I thought that the company, with its dominant market position and its innovative spirit, because over the past decade or so, it has introduced new products and services and iterations of existing products and services nearly every year. Mm-hmm. So I thought that this innovative spirit and the entrenched market position of the company will actually enable it to sort of ride out the price, the cyclicality of diamond prices. Turns out I was wrong. The company was a lot more susceptible to price fluctuations in diamonds than I thought it would, and that was even after the company actually introduced a recurring element to its service. So I think a big lesson learned there is that I've become even more wary about companies that actually depend on the price movements of commodities for their business.
Interesting. Okay. Yeah. Wow. I think Grace is asking some good question. Grace is asking, a lot of the multi-baggers that we talk about is still, in the US market or starting out in the Chinese market as well. But can we find such multi-baggers in Singapore and say Malaysia? And the second one she's asking is, when your stock go up, how do you decide when to add to your position or not add to your position? Maybe Chin, you can answer that.
So I think it just boils down to one of the fundamental beliefs as an investor. When we are not looking at the stock price itself, we are looking at the business. And we really focus on the company business developments in actually making decisions to add to, whether it's, when the stock has gone up or gone down. So I think that's really key. It's something very basic, but I think that oftentimes when you have a company stock which goes up, in her case, 200%, for example, then of course you'll feel either feel like want to sell it to lock in your gains or to actually sort of pare it down a bit. But I think that the best advice I have is always water your flowers and not your wheat. I think that every person who has a multi-bagger, if you ask them how it feels, one of the first things they'll say is, I wish I had bought more, right? But the thing here is you could have bought more, because multi-baggers don't happen over a period of 1 or 2 years. Typically, they happen over a period of 10 years. And really, if you think about it, if it's the company which you understand the best, and really understand how the business is developing since you held it longer and longer, it might make sense to actually add to it on the way up, especially when you find that it's expanding into new areas. For example, in the case of Amazon, as they expanded into AWS, it's a business completely on its own. They believe it's going to be as big as their retail business. And that's a tremendous signal that this company is going to be much more valuable than it is in the past, right? So in summary, we are really looking for developments which would add tremendous value to the company when we decide to add on the way up.
Right. Interesting, right? Water your flowers and not your wheat. Yeah. So basically, I think you are trying to say that we should always focus more on our winners and stock that really giving us our advantage. Because I think a lot of people might have this assumption. I think Victor asked this question as well. How do you stay on your conviction when multi-baggers where stocks can revert to the mean, which, if you don't mind, I think that that might be a misconception, because a lot of stocks don't really revert to mean. And a lot of multi-baggers that we talk about here, like Amazon or Netflix, over the past 10-20 years, their stock chart has actually been continuously growing. And even company like Microsoft, when you think about it, is not very innovative for the past few decades, but it's still very long multi-baggers. So that's something for us to look at. I think Tan Jian Wei is asking, maybe Sergeant can take this one. What sector do you think is best when you look for multi-baggers? And what is the next multi-bagger that you're looking for, right? Do you look for it in IPOs?
I also want to know.
Okay. Well, a lot of things to unpack. So let me talk about the IPO question first. In general, I try to stay away from IPOs mainly because it's hard to get a sense of whether or not management team will be able to treat minority shareholders fairly. So and as Chin mentioned earlier, if this stock is a good company, is a great company, then you will definitely have time to be able to buy into it as the company grows. So yeah, I'm willing to wait for more confirmation. So in general, I don't really spend too much attention on IPOs. As for the sectors, right? So I'm generally a bottoms-up investor in the sense that I don't look at, I don't try to think of what sectors are. I don't try to look at sectors and find companies in there. I'm more of like trying to find good companies, and then I try to assess the competitive position of the company and what it is doing and whether or not it's able to grow. But I do kind of agree that also that there are certain areas that I find to be really interesting and that could potentially hold pretty big amount of growth. So a few examples, right? Let me give one Singapore example, one Malaysia example, and one US example. So the Malaysia and Singapore example actually both belong to the same industry, and that would be rubber gloves. So in the Singapore market, we have Riverstone. In Malaysia, we have Top Glove and a few others. And so the rubber gloves industry is actually a pretty interesting one because there's this really strong recurring element to the revenues that companies can earn there, because rubber gloves are inherently disposable. You use them once or twice and then you have to discard it. And then as the population increases, as demand for electronic manufacturing increases, as demand for healthcare services increases, there will be this strong and sustained growth in the demand for rubber gloves, and this is where companies like Riverstone and Top Glove can both take part in. And both companies have actually done really well in terms of both business performance as well as stock price since their listing. Top Glove is a much longer listing as compared to Riverstone, but both have been really strong multi-baggers as well. So and both are also founder led, which is another trait that I appreciate. So yeah, that's one. And then for the US, I think a pretty interesting sector that I'm looking at recently is genetic analysis. So it's more of like studying DNA, and I think it's really promising because we could be entering the era of precision medicine very soon. And to be able to do precision medicine, we will actually require a much stronger capability in terms of analyzing DNA. And one company that is, I think, doing phenomenal job in this area would be Illumina. So Illumina actually builds machines that helps laboratories around the world and hospitals around the world to analyze DNA of all kinds of organisms, from simple single-celled organisms all the way to like humans and large animals. So the company has been a strong driving force in terms of driving down the cost of sequencing. So I think I don't have the exact figures off the top of my head, but I think sometime in probably the late or mid 1990s, the US government set up this Human Genome Project. It was a 15-year project with a $3 billion budget to actually study one single human genome, which is the entire DNA of one person, right? Mm-hmm. And then so the project, in the end, it was completed with about $2.3 billion, so a huge amount, and it took them, like, I think, 13 years. So it was still within the budgeted time frame and the amount of money spent. But today, right, we are on the cusp of the $1,000 genome, and a genome can actually be analyzed in a matter of days. So tremendous improvements being made over time in this area, and it's mostly been driven by Illumina with the improvements that it's been making in its technology. And so what I see is that I think as this DNA analysis technologies become cheaper and cheaper to use, more and more use cases will likely pop up in the area of precision medicine and even consumer genomics, like this company 23andMe in the US, which is trying to analyze our ancestry and all that. So I think there could be very, very interesting use cases for DNA analysis popping up as the technology to analyze it becomes cheaper over time.
Wow, interesting. Definitely, you are giving me ideas as well. So I'm writing this down. Okay, no, but there's a lot to process. I think even for, say, someone who is just starting out in trying to find multi-baggers in the stock market, or maybe just want to add some of this growth company in the stock market, how would you maybe give them a sense on your, say, hit rate of all the multi-baggers that you hit? Generally, how many percent should we be expecting that we're going to lose money on it? Chin?
Wow.
Because it's impossible that if we are especially investing in this kind of new industry, it's very highly unlikely that we're going to make a good investment all the time, right?
Right. I'm trying to think what percentage it is in my portfolio.
Yeah, that would be good.
Because over time, actually depends on how you measure as well. You can measure based on how much you spend on it, and also how much you or how much value it is in relation to your overall portfolio. So I would think maybe 10% in my case. But in actual fact, I also want to go
10% losses or what?
10% of your picks will probably lose.
Okay.
Okay, when you say
right?
Lose, you can
Just take
you
my
can
money.
either say lose money,
Okay.
or lose to the market, right? So if
okay, let's simplify it. we don't talk about the monetary returns. We just say that of 10 picks, how many picks would actually lose money in your experience?
Okay, before I go there, I think there are ways to actually limit the amount of risk. So even within the world of what we like to call as growth investing, there are safer ways to invest. You can invest in companies with plenty of free cash flow, plenty of cash. Then I think your probability of actually making a loss based on that becomes substantially reduced. So long as the position which they have is sustainable, right? So there are safer ways to invest within the growth, and maybe by playing it more safe, you might limit the amount of returns you might actually get, because you're not actually trying the crazy ideas like DVD by mail 10 years ago. But on the other hand, I would say one or two probably won't do as well, at least.
Okay.
Probably 3 or 4 will lose to the market.
Right. Okay. So about half of it will not really reach the type of expectation that you might have, right?
Yes. So I think Peter Lynch was the one who said that if you get 6 out of 10 of your picks correct, you're actually doing quite well.
Okay. Interesting.
So
okay.
I believe that ratio is pretty accurate.
Right. Okay. Yeah, I think we are running a little bit over time, but it's okay. Let's try to talk a little bit more on the current things that's happening in the market. I'll ask you, Sir Jing, what do you think? Should investor be worried about, say, the possible trade war, or that's just a distraction? How do you see that when you are looking at your own portfolio?
Okay, so recently I read this really brilliant article written by a journalist and author called Roger Lowenstein. So he actually looked at Berkshire Hathaway's investment returns and stock market performance over time. And guess what? Over the past 51 years, right, Berkshire Hathaway's book value per share has increased by about 19.4% per year. That's over the past 51 years, so since 1965. So I don't even know how many crises the world has gone through since 1965, right? Like countless. And guess what is the compound annual growth rate of Berkshire Hathaway stock price? Take a guess.
20%?
Yeah. So Berkshire Hathaway stock price has compounded at 20.4%. So think about this: 19.5% book value growth rate, and then you have a 20.4% stock price increase. These two figures match up really, really nicely. And I think it's a perfect example of how, a company, if you have a good company and you focus on its business developments, and then all of these worries about macroeconomics, about politics, about trade wars, commodity price movements, and all that, all of these just kind of washes away over time. And the Berkshire Hathaway example is a really good kind of reminder for me that over time, it really is the fundamentals of the business that drives the stock price performance. And so to answer the question, yes, the trade wars are something to keep an eye on, but it's not going to heavily affect my investment decision whatsoever. I mean, of course, if it's a company I'm looking at that is, say, producing steel, then that could be something that I'm kind of concerned about. But then the question becomes will these trade war be a permanent thing, or is it going to be a temporary thing? I can't really answer that. And so and then my thought process will become, how about instead of looking at a steel company, I try to look for a company that has a really kind of a clear ability to grow over the long term, and then that will bring me to areas in the world where I think there's a kind of a clear secular long-term trend happening.
Interesting. So no matter what, stay invested. Chin, I think we'll close off the interview with a last question with you. What do you think of Facebook now?
Facebook? Well, what about it?
Okay, so there's a lot of media attention on Facebook. And is it the kind of stock that you will consider is a multi-bagger stock? And would you consider, what's happening now, just something that's temporary or something that's more structural?
Let me check. Where is this hosting this interview on? So I think Facebook is the kind of company where it's you cannot name the Pepsi to the Coke. So if you have a company like Coca-Cola, right, and if you're asked to name a competitor, the immediate name you'll come up with will be probably Pepsi, right? But if you have a company like Facebook, and if I were to ask you to name a social media company, which is the second player, I think most people will struggle to find a name. So should we be concerned about this recent kerfuffle which they had? I think there are some serious questions being asked right now. Will there be regulation? Maybe. But in the end, I think where do people want to go? Where do you have 2 billion users who majority of them are actually logging on every day and have this kind of engagement? So I just think that yes, it'll probably be a concern, but I think over time it'll be shown to be a short-term concern.
Right. Very, very good. I think that's all we have time for. We actually still have many questions. I have to apologize to say Karen, KJ, William, Kok Kwan, who have sent in the questions. I'm sorry we couldn't finish all of them. Hopefully we can get these two guys back again very soon. How about that, right? But it has been a pleasure talking to both of you, and thank you very much. I'll see you very soon.
Thank you for having us,
Thanks,
man.
Danny.
Bye.
Yep. See ya.
Bye.